It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of Bank Information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
To the Your Personal Bank Show. Today I want to respond to a number of emails that I've been receiving recently, questions that folks have been asking. Some of these are from folks that have been listening to the show, obviously some of them for quite some time, so thank you. And others actually I met with and had initial consultations with or various things. But, I want to address some of these. And again, I want to really encourage people. I appreciate the feedback and the response that I've been getting. I understand that your personal bank is a financial concept that's different than what most people are familiar with or been introduced to. Again, we're setting up a high cash value policy. This is designed to maximize cash growth, maximize dividends. We have companies that have been paying 6% plus dividends for the last 25 plus years, never missed a dividend since literally before the Civil War. A lot of people are surprised by that fact when I show them, and these are A-rated companies, multi-billion-dollar companies that people are name brand companies, if you know what I'm saying, folks are familiar with, and they're surprised that they've been paying these dividends for so long. And don't realize that a high cash value policy structured correctly, like we do, can really be a wealth generator. So that's obviously interesting. And then, of course, the next step is we set up a bank line of credit. And we have banks that are charging anywhere from 3 to 3.95% when accessing funds from the bank line using the cash in the policy as collateral. And, of course, the key is when you access the money, you keep the difference. So I always ask a simple question. If you're earning 6% dividends and you're getting charged in the 3% range interest when you access the funds, well, what's your money doing? Obviously, the answer is you're keeping the difference. Your money's still growing. It's still earning. That's called positive arbitrage, which is, again, one of those things I always talk about that some people think is a complicated concept. It's not. It's you're earning more than you're getting charged when you use the money, and you're keeping the difference. So again, if you leave the money in the policy just to earn the dividends, can you do that? I had a client actually ask me out on the phone today, and the answer is of course. A place to put their money, as they put it. They were looking at it as, they want a place to park their money. They want it safely. They didn't want any market risk. They wanted to reduce taxes or minimize them. They wanted to keep liquidity, access to most of the money. Well, your personal bank policy can accomplish all those things. It can be a really great fit for that. Oftentimes much better than many other options out there. But then if you do that, of course, your money's, getting that I'm going to say 5 to 6% dividends today, given the current rates, depending on which company we go with and who has the best cash values, depending on your situation. I'll go over all of that with you if you contact me at yourpersonalbank.com. But then the second step, of course, is the bank lines are super easy to qualify for. It's a fully collateralized loan. The cash is in the policy. Again, up in 95 to 100% of the cash will be available, depending on your credit score, and the cash in the policy will be available. All right, it's like a one-page app. It's super easy. It's the easiest app you've ever completed, probably for any kind of credit type of thing. And here's the key where the questions come about all the time. Because what folks do is they understand, generally speaking, most people understand, hey, I put the money in there, I'm earning the dividends, I'm setting this account up primarily to grow money, grow my cash, earn dividends. Not so much for the insurance aspects of it, although there is a policy. We're minimizing the insurance side to maximize the cash. It's nice to know that's there just in case. There's money's available for long-term care expenses also. People often forget that, but that can be very valuable. But my point is, for most people, the primary focus is to grow they want to maximize dividends, and they want to do it on a safe manner and minimize the taxes, right? As I stated, up to 6% dividends still today. That part's usually pretty straightforward. Most people understand that. Not overly complicated. You know what I'm saying? Where people get their things twisted up a bit, or they get asking the questions, or they start to kind of miss the point sometimes, is in the bank line, accessing the funds and the positive arbitrage. Because here's where people get hung up. I'm just telling you straight up, and this is where the questions so many of the questions revolve around, well, if I access money from the bank, that means I'm going to owe the bank. And the answer is yes, of course you will. There will be interest charged. Now, here's the thing to understand, though. And understand this. The reason why the hang-up is there so often, people sometimes struggle to get over, it's that paradigm shift in thinking. It's that mental block. How's that? Is so often we're taught or we heard or we feel like that, well, debt is bad. All debt is bad. And eliminate debt. And what I would say is, generally speaking, the answer to eliminate debt or reduce debt is generally speaking a good thing, but understand if it's consumer debt, there's a difference. Again, consumer debt is that type of debt where you have to make payments, right? You have to work to make the payments. You have to go to work. So your business, your job, whatever it is, you have to earn income to make those payments. That's where things can go wrong. That's where things can be, well, there can be challenges if you are unable to make those payments, obviously. We all know the negative consequences and the horror stories involved with that. Strategic debt is different. Strategic debt can be used to build wealth. And a great example, an analogy I use for folks all the time is, assume you owned a rental property. And let's assume that you took a mortgage to purchase that property. And let's assume that the rent that you gain from that rental property exceeds your expenses. In other words, you have debt. You took on debt to purchase the property, to purchase the rental. But the renter is paying the cost of the debt and then some. There's profit, right, involved. Can you build wealth that way? And the answer is obvious. I mean, yes, of course. We all know about situations. I mean, that's a very common method that's used by real estate investors to build wealth. Well, this is basically using the same principle. The same idea is you're using the asset of the cash and the policy. Remember, to access the funds, use the line. And remember, this is a key point in helping understand really how this works. And that is, when you access funds. Now, first of all, let me back up a sec. Did I tell you to access funds? No. I told you earlier, if you keep the money in there, if you contribute the money to get the dividends and leave it there, obviously you can earn dividends, right? But at some point when you decide to access funds for whatever reason, again, to pay bills, to buy things, to purchase things, or supplement retirement, or anything else for that matter, when you access those funds, here's the key. You're going to access them, and the cost of accessing them is less than what they're actually earning. As I stated earlier, today, you're still earning a 5.75 to 6% dividend with a long-term track history of doing that and getting charged in somewhere in the threes. So the average client, by the way, right now is earning about 2.5% positive arbitrage. So in other words, if you access money from it, and remember, are you taking the money from the insurance company or are you taking it from the bank? That's a key point. That's a key point in understanding. The answer, of course, is you're accessing the funds from the bank. Remember, you contributed funds into the policy to earn dividends, right? And then we set up a bank line of credit using the cash in the policy as collateral, and the bank is giving you the money. Therefore, you owe the bank money, not the insurance company. The insurance, the money you contributed is still in the policy, right? And what's it doing? Earning dividends. Because you did not withdraw or take or loan or access any funds from the insurance company, that means all the money you contributed is still there, isn't it? Which means it earns dividends each year, which means whether you add money, additional funds or not, it's going to grow, and it's going to grow on a compound basis. Every year, there's going to be more and more funds available, right? So this is a key in understanding this, how this all really works. When you decide to access the funds, you still get to keep a portion of the gains. Because again, if you're getting a 2.5% positive arbitrage, you're earning more in dividends than you're getting charged, you're still earning 2.5% roughly on money that you spent or allocated elsewhere. See, that's the key. That's the key to your personal bank concept. And I even had another client talk to me today about, well, we just wanted a place to put the money and park it and let it grow, and we want it safe and want, minimize taxes and minimize risk and all that, which they like the idea. But they were like, well, we don't want to have to set up a bank line and access it and owe the bank any money and all that. And again, they're missing the whole point, because what were they putting the money away for? See, what they lost sight of is they're putting the money away, in their case, to later supplement retirement. They had no immediate or short-term plans of accessing those funds. But at some point down the road, they plan to, obviously, right? To supplement their retirement. Now, if they invested it somewhere and they got a return, that's fine, well and good. But when they start to access the money, what's going to happen? When they start to access the money, the amount of funds in that account will decrease, right? Therefore, their returns will decrease because there's less money in their account as they deplete it further and further over time, right? Here, because you're still earning some positive arbitrage on all the funds you access, plus what's there is still earning the full dividend, well, your money's going to last longer, isn't it? Because all your money is still working for you. At least you're getting some kind of return on all the dollars. And that's the part they missed. And again, they missed it. The mental block was because they didn't want to owe a bank any money. But here's the thing to understand. The interest on the bank line is one of those things where, yes, you'll be charged interest, but do you have to pay the interest? And the answer is no, you do not have to pay the interest on the bank line. Now, should you, if you can? Yes, I encourage people to do that. And sometimes there's tax reasons because the interest can be tax deductible oftentimes for business purposes and other things like that. There's many times where you actually want to pay it. It's beneficial for you. But if you do pay it, it means, if you pay the interest, on the loan, on the funds you access from the bank line, what does that mean? It means your cash is growing in the policy, compound growth, but your amount you owe the bank never increases because you're paying the interest. So you're borrowing at simple interest and you're earning at compound interest. Look, if you understand the difference of that, over time, that can be very, very significant. So I'm going to encourage you to stay tuned in the next segment. We're going to talk about that further and a couple other questions that I get, just got this week. We'll put it that way. So stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and I've been responding today to a number of questions that folks have been emailing to me. Both those have been listening to the show, and a few who I've actually met with recently, initial consultations, that type of thing. And the first question I was addressing in the first segment is really about understanding the interest on the bank line. Now remember, we're setting up a high cash value policy to maximize dividends, to earn dividends. Then we're setting up a bank line of credit using the cash in the policy as collateral to then later, at some point, access funds whenever you want. And the difference, what the bank is charging is less than the dividends you're earning. Therefore, you keep the difference, which is positive arbitrage. And the average client I work with today is getting about 2.5% positive arbitrage. Some a little more, some a little less, depending on the situation and size of the account. The thing is, the mental block some people have is, I don't want to set up a bank line. I don't want to access money from a bank. I don't want to owe money to a bank. And I understand where that's coming from. That's a desire to eliminate debt, which is generally a good thing, especially consumer debt. If you have to work to pay it off the bill, you want to get rid of that kind of debt because you can get in trouble otherwise. But this is strategic debt. This is money. Remember, the money is actually, you're not accessing it from the insurance company. You're actually accessing the funds from the bank. You contribute to the insurance company, then access through the bank. The bank gives you the money. The insurance company has all the contributions you gave them, right? In other words, it's going to earn dividends. It's going to grow 6% plus last 25 years. 25 plus years, never missed a dividend since before the Civil War. Tremendous long-term history of paying dividends. The bank lines, historically, it's one of the questions I was asked in a recent email. Is there a time where the positive arbitrage situation didn't work? Well, in the last 40 years, one of the companies has given me the documentation, the statistical information, all that good stuff. And in the last 40 years, every single month, the dividends that was earned was higher than the interest charged, except for 2 months out of the last 40 years. And those 2 months, it happened to be equal. So therefore, it wasn't underwater. It didn't hurt you any. Didn't help you, didn't hurt you. 2 months of the last 40 years. That's a powerful, tremendous story and history. And that takes care of low, moderate, and high interest rate environments. Look, one of those things, and I'm going to talk about this, I know, in the next show, is the increasing concerns about inflation. Look, if you have a concern about future inflation rates, your personal bank is probably one of the best places to look for as a hedge for that. Why? Well, the reason is quite simple. The dividends are highly interest rate sensitive. Insurance companies primarily invest in corporate and government bonds. The vast majority of any of their portfolio, when we give them money, what do they do with it? They invest it to make more, right? And the typical insurance company today, the average insurance companies earn around 8 to 10% profits on the returns on what we give them. They're very good institutional investors. And as I point out, I can show you the last year's corporate report on several of the companies if you want to take a look at it. And what was interesting is, like, one of my favorite companies that I've been recommending people because of the highest cash values, they've been averaging upwards of 9.5 to 10% returns pretty much consistently, except for 2000, which was a rough year. They still made 8.1%. Or it was 8.3. I don't remember exactly. I don't have the thing in front of me, but it was in the 8% range. And my point is simple. If they're making 8, little over 8, can they pay? And that particular company pays a 5.75 dividend, and they have a strong cash, a history of paying high cash dividends. We're talking the last 100 plus years. Okay. My point is simple. If they're making 8.1, 8.3, something like that, can they pay you 5.75? Well, on billions of dollars, the answer is yes. There's plenty of room for profit there, isn't there? And I can send you the annual report if anybody wants that. Contact me at yourpersonalbank.com. Be happy to send that to you. My point is, though, they are literally, the dividends are consistent and strong and have been for a very, very long time. Interest rates can change. Dividends can change, but they tend to correlate. And like I stated earlier, in the last 40 years, been in a position where the dividends being paid were at or higher than the interest being charged. So that was one of the questions I got recently in email that I thought I should address, because it bears down to, it gets back to the other question that I started talking about in the first segment. And if you missed it, I'm going to encourage you to go to yourpersonalbank.com and check it out. You can listen to any of the previously recorded shows, by the way. And here's what I want to say about that. The hang up, the mental block is people not wanting to borrow, owe money, right? Well, again, if you're accessing funds from the bank, not the insurance company, and the insurance companies, the funds are getting dividends higher than what you're getting charged. Even when you spend the money, you're still making money. You're keeping the difference, right? And again, the average arbitrage right now is about 2.5%, which is fairly common historically, by the way. So again, it's a very strong positive arbitrage scenario. If you're earning interest, you're keeping positive arbitrage, I should say, on monies that you spend, well, doesn't that mean you're going to have more? I mean, if you're using this ultimately to supplement retirement, for example, it means there'll be more dollars available for your retirement because even some of the dollars that you did spend for retirement are still earning you some positive arbitrage, still earning some interest, still growing, giving you more monies available. See, this is when strategic debt is a good thing, just like owning a rental property that's cash flow positive. You can build wealth that way. And that's where, again, sometimes people have that hurdle, that mental hurdle. That's what you need to get over is realize, hey, I can actually make my money go further. I can have more money. And my point is, paying back the interest on the loans is not required. The bank will allow you to just increase the line. You have the option. It's up to you. That gives you powerful and tremendous, control of your money also. Because let's say you do want to access some funds for whatever reason, and you do intend to pay them back, but you're not sure on what schedule, or you want to have some flexibility in terms of when and how much you want to pay it back. See, with most loans, you don't have that kind of flexibility, do you? When you do traditional lending and you access monies, there's a payment schedule, right? And if you miss that payment schedule, bad stuff happens. Well, here you can skip, not make payments for a fairly extended period of time and pay it back on when you want to or never. We can structure it so that even if you never pay it back, you still have more money available each year because of the positive arbitrage. That's a common scenario, for example, for when somebody's using this to supplement retirement. They have no intention of paying it back. So that type of debt is not only not harmful, it's actually beneficial. Stay tuned in the next segment. We'll talk about this further and a few other questions, so don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. Today we're talking about some of the questions that folks have been asking me recently, sending me emails. I really encourage you to do so. You can contact me at yourpersonalbank.com if you want more information or just have a question. I do really appreciate the feedback because I've been getting a lot of positive questions and feedback. Folks wanting to develop some more and better understanding of how this financial concept works, and it helps me know what people what you want to know. You know what I'm saying? So I appreciate it. But one of the other interesting questions, I get this one quite often, but I got this recently, so I thought I should address it. It was just, let's see who it was. Yeah, so I'm looking at the email right now, and I was just curious. Theoretically, what happens to our cash value and our death benefit if the insurance company were to go bankrupt? That's a very valid question, and it's not uncommon that I hear that one. And, of course, the problem is we've seen banks go under and things like that. Well, there's an organization. Basically, first of all, let me back up a second. First of all, these are the companies that we're dealing with are A-plus rated, multi-billion-dollar, very conservative and highly regulated financial institutions. In fact, insurance companies are more regulated and more restricted in what they can invest in than, just about any other type of financial institution that exists. The other thing about it is they have to file, and they're under regulations by each state, by the Department of Insurance of each state that they do business in. And most of these, all of these companies we work with do business in all 50 states. So they literally have to go through approvals and compliance and everything else with 50 different regulators. That's a lot harder than to do through one federal, for example, regulator. Answer to 50 versus 1. So it's actually a greater level, in my opinion. It's a higher standard even, and a more difficult standard that they have to adhere to. And, that can be argued, obviously, either way. But, answering to 50 regulators versus 1, I think makes logical sense that they're pretty well scrutinized, if you know what I'm trying to say. And also, insurance companies, unlike banks, cannot leverage money. Banks, we all know, Federal Reserve, the Federal Reserve System, and fractional reserve lending. let's just put it this way. In essence, create money out of thin air, right? The Federal Reserve does. And a bank, by the way, FDIC, I happen to know this, being involved in the banking side of things, being on a bank board. A bank goes on an FDIC watch list if its reserves get below 6% of deposits. So in other words, if a bank has $100 of deposits, all right, their reserves need to be at least $6 or higher. 8 is the average, roughly, by the way. The average bank has about $8 of reserves for every $100 of deposits, and that's considered a healthy bank. When they get below 6, they go on the FDIC watch list, and then we all know if they get too low, FDIC can step in and take over the bank, and typically what they do is bring in another bank to, in essence, seamlessly take over. That's why, FDIC insured banks or FDIC insured accounts. That's why people with an FDIC insured account don't lose money. Okay? Insurance companies can't leverage like banks do at all. They can't leverage at all. In fact, some of the latest studies, statistics, and things I've seen is the average insurance company has something like $106 of assets for every $100 of liability. That's a big difference. 106 versus, say, 8, right? In other words, they're very, very well capitalized. They have to be. They're required to be. And that's why it's very, very rare and infrequent when an insurance company gets into financial challenges. Some of the other things to understand about insurance companies is when you're talking about life insurance in particular, these are investments that are designed, they're looking at the lifetime of an individual before a death benefit has to be paid out, for example. And the cash growth and dividends that are being earned over a lifetime. In other words, their time frames are typically decades. They're looking at the lifetime of somebody contributing, an investor, so to speak. Many decades versus banks who look at quarterly returns, right? Many of them are owned by stockholders, and they have to answer to that. Much different view of a quarterly return for a stock or a mutual company, let's say, or a bank, versus a decades, lifetime type of time frame. But the last thing is there's an organization called the National Association of Life and Health and Guarantee Association. Let me give you the actual information because you can go online and check this out further. It's NOLHGA.org. So it's National Organization of Life and Health Guarantee Association. They operate much like FDIC in terms of being a backstop or a safety net, and they have guarantees in place in case an insurer does happen to fail, much like FDIC. So as you can see, they're set up much more conservatively. They can't leverage, and then there's a backup on top of it, just like FDIC with banks. Stay tuned in the next segment. We'll talk about this further, so don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and I got to apologize. I was talking about the some of the safety net things and ran up against a hard break. So I really want to finish up on the thought from the last segment. The question that was asked was, and I'll read the email, it even says here, well, theoretically, what happens to our cash value and our death benefit if the insurance company were to go bankrupt? And as I was pointing out, first of all, that's very rare occasion that an insurance company gets into a financial problem. First of all, we're dealing with A-plus rated, multi-billion-dollar companies that have been around for, most of them, well over 100 years. I'll put it that way. Most of them since before the Civil War. So we got tremendous long-term, steady, consistent financial situations. But on top of that, insurance companies can't leverage like banks. Failures often happen. People think of them. They think about banks. And again, the reason is banks do fail from time to time. We've seen it in economic situations, and it's due to their leveraging capacity through the fractional reserve lending. As I stated in the last segment, the bank last information that I saw, we'll put it that way, most recent that I've seen, is a bank goes onto a FDIC watch list if their reserves get below a roughly $6, 6%, in other words, $6 of reserves for every $100 of assets. And a healthy bank average bank is around $8. So the typical bank has around $8 of assets for every $100 of liability or loans, right? Now, the loans generate income, and if they're good loans, the bank's going to do just fine. And if they don't, FDIC steps in and basically covers them, takes care of the folks who deposited. So that's why people haven't lost money in a federally, FDIC insured account, well, since it got started in the 30s, right? Insurance companies can't leverage. In fact, the average insurance company has somewhere about $106 of assets for every $100 of liability. That's a tremendous difference. Some have even higher than that, and most of them we deal with do, okay? So they got tremendous amount of cash reserves. They can address their liabilities with no issue. They're not leveraging, and they're looking at much longer investment time frames. When you're talking about life insurance particularly, somebody's contributing to that to get dividends like we talk about. They're talking about receiving dividends over their lifetime. The death benefit that's going to be paid out is not going to be paid out until the end of someone's life, which oftentimes is many decades in the future. So in other words, the underwriting that somebody goes through with a life insurance company, the underwriters are amazingly accurate on statistical averages in terms of how long somebody's going to live. Not each individual person, but a group of insureds, they're upwards of 98% or above accuracy in knowing the average life expectancy of that group of people. In fact, that's another common misconception. Some people say, I don't want to get life insurance because I don't want the insurance company betting against me. In fact, it's completely the opposite. Remember, we're maximizing cash to maximize dividends and minimizing the death benefit, but there still is one. In most cases, that's what we're doing. There still is one, so there's still that underwriting life insurance approval process, which many people get messed up thinking it's very difficult. It's not. It's pretty simple. And with today's technology, it's gotten much more simple. Very rarely does it even require an exam, by the way, anymore. But the point is, I'm divesting here a minute. The point I'm trying to get at is, if you knew with a 98% accuracy rate, let's say, of how long you were going to be able to invest the money, and that was going to be for several decades at least, could you be profitable? The answer in most cases is yes. I also shared that the average insurance company, the better ones, I'll put it that way, their corporate reports show 9 to 10% average returns on their investments annually. They're very good institutional investors, okay? And if they're making somewhere in the 9 to 10% range, can they pay you in the 5, 7, 5, 6% range as they are today, dividend? And the answer is absolutely, easily, no problem. You see what I mean? And have a long, long track record, again, some of them since before the Civil War, of doing that. So my point is, if your time frame and your thought process is long-term, you're not leveraging, and lastly, okay, many banks have stockholders. They got stockholders, dividends, things like that to address, quarterly returns and those things. A mutual insurance company has no stockholders to answer to or address or pay dividends to. It goes to the policy owners, you and I, the folks that are looking to maximize dividends. That's why so often there's so much more dividend than most people realize. So, but to fully answer the question, as I was starting to say earlier, what if the company did happen to go under, the insurance company? It rarely happens, but on the rare occasion it does. Well, there is actually an organization called the National Organization of Life and Health Insurance Guarantee Association. And their website, which I encourage you to check out if you want, is NOLHGA.com. Again, it's Nancy, Oscar, Lima, Harry, George, Alpha.com. And that'll give you all the information, and like it states, they're the safety net. They operate basically in the rare occasion an insurance company does happen to get into financial problem, then they guarantee the cash values and death benefits up to a certain limit, which is different in each state. You can check it out on their website. And that'll make you whole, just like FDIC does for banks if something happens to them. So not only is it the just the inherent safety of an insurance company and how they operate and the long-term investment approach and they can't leverage and all those kinds of things versus a bank, let's say. Not only is all that in place, but then there's the second layer of protection, the National Organization of Life and Health Insurance Guarantee Associations. Again, the website, if you missed it before, NOLHGA.com. Check it out. That gives you, it's a tremendous safety net, as they put it, even in their website, to make sure people are whole and they don't lose their money. So again, this becomes a very, very low risk investment with guarantees built in, without the market risk, with the consistency of the dividends, all that kind of stuff. And then when you add on the bank line, so then you can access the money and get a positive arbitrage situation, that's the icing on the cake. That makes this thing really go, because you can increase the rate of return on investments. You can still earn money on funds that you were allocating elsewhere. Let me give you a quick example. I had a client talk to literally a couple days ago, a relatively new client. He had set up his policy, he'd set up his bank line, hadn't used it yet, and then he called me about he had an opportunity to invest in a note, a first position note, real estate note, and he's getting 7%. He's happy with that. And he likes the fact that he has a deed of trust and he's in the first position. So he's got some relative safety there. He's got some collateral there. We'll put it that way. If the person offering the note doesn't pay him, he would get the property. All right. So I said to him, well, you have a choice. You could, and he had the money to invest in the note. And I said, you could take the money and invest in the note, get the 7%, or you can access the funds from the bank line and take those funds and invest in the note. What's the difference? Well, if you invest it straight up, you get the 7%, assuming everything works out with that note investment, right? Well, if he accesses it through the bank line, and in his scenario, his situation, he's earning 5.75 dividends on the cash, and the bank is charging 3.25% interest. So bottom line is, he's still going to get 2.5% positive arbitrage on those dollars, isn't he? Because he's earning 5.75 and getting charged 3.25%. The difference, 2.5%. And what's he going to do with that money? Take that money, give it to the investor, and get his 7% on the note. His net return now, 9.5 versus 7. So I explained that to him. He liked that, and I just asked him a simple question. Would you rather make 7% or 9.5 on your money? Well, that was an obvious answer. Okay. That's a perfect example of how your personal bank, a very simple, straightforward example of how your personal bank enhances returns on investments. You pick up the extra positive arbitrage. So it just makes sense. And oh, by the way, depending on how he structures this, if his note investing, if he sets this up in an LLC and it's a business proposition, and depending on the scenario, obviously, talk to your tax advisor, but the interest on the loan from the bank could potentially be a tax deduction as a business expense. So not only could he pick up the 2.5% positive arbitrage, but he also could pick up a deduction on the interest that's being charged by the bank, which would mean an even greater rate of return. Folks, this is the type of thing I deal with and work with on folks every single day. This is how you start taking control of your money. Now, by the way, let's go back to this gentleman. He's going to get a monthly interest charge. His dividends of the insurance company, the money's there, so he's going to keep getting the dividends, period. That's pretty straightforward. Most people understand that. Let's look at the bank side. Remember, he's accessing the money from the bank line to invest in the note. The bank's going to charge him interest. Now, should he pay the interest? As I stated earlier, if he can get a tax deduction as a result of business activity, certainly, because it just benefits him further. But even if he doesn't get the tax deduction, he's still going to benefit if he can pay the interest, take a small portion of the profits of the note and pay the interest. The amount he owes the bank will never increase, But the dividends, the cash in the policy will grow compound, and the interest he'll be charged would be simple interest. Folks, over time, that can make a big difference. Okay? But here's the best part about all this. He has the option. He has the option to pay the note, the bank line back, or pay the interest if he wants to, or not pay the interest if he doesn't want to, or is unable to for some reason or a period of time. Because if he can't pay the interest to the bank, all he has to do is tell the bank to increase the line by the amount of the interest. What does that do? It's a real simple thing. It puts him back in control of his money. He can pay back the loan or not, pay back the principal and or interest or not, all on his own schedule, in his own timing, when it makes sense for him. Or he doesn't have to pay it back. As long as he's earning more dividends and he's getting charged interest, he'll have more money available each year because the bank line will increase. The amount of money that is available in the bank line is between 95 and 100%. In his case, it's 100% because of his credit score. And he's got access to that money. And when the amount of money increases in the policy, the bank line increases along with it. Therefore, having an increasing amount of funds available each and every year. In fact, there's a minimum guarantee interest that the insurance company dividend has to pay, which is higher than the interest being charged by the bank currently. Which means at this point he's guaranteed to have more money. Period. But again, these are companies that haven't paid less than 5.75 or 6% dividends for the last 25 plus years. So my point is simple. He has a choice. He can invest in this note and get his returns on the note and the advantages he gets with that investment, or he can add on, use the funds from the bank line, from his insurance policy, the collateral from the insurance policy, use his bank line, get the positive arbitrage and the benefits of his investment, therefore increasing his rate of return. In his case, he's going to increase his rate of return from 7%, which is what he's getting on the note, to 9.5%, which would be the combination of both, the note plus the positive arbitrage. And folks, you math folks know that is a tremendous increase on rate of return. Contact me at Your Personal Bank for more information, and as always, stay tuned to the Your Personal Bank Show.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and writers may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and bank line of credit rates may change. Contact yourpersonalbank.com for current rates.